Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. On behalf of K Ratings, welcome you to our today's webinar on credit quality assessment for the first 9 months of FY2019. Appreciate your time in joining us for this webinar. Our speakers for today is Smita Rajpurkar, Associate Director at K Ratings. Along with her, we have Kavita Chacko, Associate Director and Senior Economist. The discussion is in form of a presentation which is visible on your screen. We'll be having a Q&A session no sooner the presentation ends. I request Kavita to begin the session.
Good afternoon and a warm welcome to all. In this webinar, we provide an insight into the overall credit quality of Indian corporates spanning sectors, segments, and categories based on the assessment of CARE Ratings 2 indicators, that is the modified credit ratio and which is the MCR, and CARE's Debt Quality Index CDQI, both of which capture changes in the credit rating of entities over time. Any assessment of credit quality should be seen in conjunction with the underlying economic scenario, as the economic and business conditions have a bearing on the financial and business performance of entities, which in turn determines the credit quality. The credit quality of an entity is essentially its ability to service its debt obligations as per schedule. The movement of some key and broad economic indicators here highlights the overall weakness in the economy in the ongoing financial year. India's GDP for the current financial year is estimated to grow at the slowest pace in 11 years. As per the advance estimates provided by the government, the GDP growth is forecasted to be 5% in 2019-20, which is a significant drop from the already low growth of last year. There has been a progressive decline in the country's economic growth rate in recent years. GDP growth has slipped by over 3% since 2016-17. The weakness in the economy is seen to be fairly broad-based and spread across sectors and segments. Industrial output has seen a sharp drop in the current financial year to multi-year lows. During April to October 19, industrial output as measured by the IIP, that is the Index of Industrial Production, grew by a mere 0.6%, significantly lower than the 5.7% growth of a year ago. Similarly, exports too have seen a steep decline, with growth during April to November 19 contracting by 2% compared with the positive double-digit growth in the comparable months of the preceding 2 years. Credit offtake from banks has been lower in the current fiscal, indicative of subdued economic activity. The incremental non-food bank credit during April to October 19 grew by a mere 0.3% versus the 4.1% growth during the same period of a year ago. In terms of the industrial and services sector, there has been a contraction in the incremental credit offtake this fiscal. Now coming to CARE's indicators that measure credit quality, that is the MCR and CDQI. The modified credit ratio, or MCR, is defined as the ratio of upgrades and reaffirmations to downgrades and reaffirmations. An increase in MCR denotes an increase in proportion of upgrades vis-à-vis downgrades, whereas a decrease in MCR shows the reverse. In other words, an increase in the MCR implies an improving credit quality of the rated entities, while a decline in the same signals a deterioration in credit quality of the rated entities. An MCR closer to 1 indicates higher stability in the ratings with a larger proportion of reaffirmations. As to why the MCR is a relevant indicator, though not an outright forward indicator, the trend in the MCR provides valuable insights of credit quality at the overall levels. The movement of the MCR, consequent to the periodic review of the credit rating of rated entities, which points out the improvement, stability, or weakness in the financial profile of these entities over time, not only helps measure mobility in ratings, but it is also seen as being reflective of the changes in credit quality in the system, given the large quantum and diverse set of entities rated by CARE Ratings. Coming to CARE's Debt Quality Index, or the CDQI. Uh, the CDQI denotes the quality of debt that can be interpreted over time and juxtaposed with other developments in the financial sector. The CDQI captures on a scale of 100, which is an index value for base year FY12, whether the quality of debt is improving or declining. Debt-weighted movement in ratings is tracked on a monthly basis for a sample of over 1,600 companies from CARE's portfolio of around 3,000 companies as of March 2012. As to why the CDQI is a relevant indicator, an upward movement indicates improvement in quality of debt benchmark against the base year. As it is contemporary with minimum time lags, the health of the debt and credit market is encapsulated on a near-time basis by this indicator. It needs to be emphasized here that the MCR and CDQI is a valuable statistic that captures the macro picture of the credit quality of rated entities over time, and that although it throws light on sector-wise changes in credit quality, it does not focus on individual company-specific details. Now coming to the trend in MCR. There has been a perceptible moderation in the credit quality of entities rated by CARE Ratings in the current financial year, as has been seen from the decline in the MCR, which attests to the slowdown in the domestic economy. The credit quality of rated entities, as measured by CARE Ratings MCR in the first 9 months of 2019, has been the weakest in 6 years. It, however, needs to be noted that despite the moderation, the MCR has been greater than or equal to 1 during this period, indicative of the relative overall stability in credit quality, that is, the higher proportion of reaffirmations of ratings. In the 9 months of 2019-20, although there has been a decline in the proportion of rating upgrades, the reaffirmations of ratings has seen an increase, and rating downgrades at 15% has been stable when compared with ratings reviewed in the corresponding period of year ago. 17% of ratings reviewed by CARE Ratings during the first 9 months of the current financial year were reaffirmed, 2% more than a year ago. Upgrades, however, declined to 11% from 14% in the 9 months of a year ago. Coming to the segment-wise MCR, the deterioration in credit quality in 2019-20 has been more discernible in case of large and medium-sized enterprises, that is the LME segment. This has weighed down the overall credit quality, given that this segment accounted for 70% of the entities whose ratings and financial position was reviewed during the first 9 months of 2019-20. Although the credit quality of small size entities, that is the SMEs, has been tempered in the current financial year, a majority of entities in this segment had witnessed relative stability in credit quality. That is, the MCR here has been over 1. The SME segment comprises of entities whose total revenue is less than rupees 100 crores or whose debt is less than rupees 50 crores. Now coming to the category-wise MCR, the moderation in credit quality here has been broad-based, that is, covers below investment grade ratings as well as investment grade ratings, both of which witnessed a decline. The entities which carried investment grade ratings has seen a higher degree of moderation in credit quality in the current financial year. Over 55% of the entities whose financials were reviewed carried investment grade rating, that is above BBB minus. Even as the credit quality of entities with below investment grade rating continues to be pressured, it did not deteriorate significantly in the first 9 months of the current financial year. I now request Smita to highlight the reasons behind the movement in the MCR the sector-wise changes in credit quality, as well as to take us through the trends in the CDQI.
Thanks, Kavita, for taking us through the MCR trend. I'll now go through the reasons for the downgrades in the 9 months FY20. We will take this sector-wise. If we look at the BFSI sector, the reasons for the downgrades have been classified, and if we see the reasons for the downgrades in the BFSI sector in the 9 months of the financial year 1920, it was the major reasons were the deterioration in the liquidity position, the moderation in the profitability, the deteriorated capitalization and leverage, moderation in asset quality parameters, and moderation in the asset profile of the entities. There were other reasons for the downgrades in the BFSI sector, like the changes in management, moderation in liability profile, reduced scale of operations, etc. If we analyze the reasons for downgrades in the manufacturing and services sector in the 9 months of the financial year 1920, the major reasons can be seen to be moderation in liquidity position, reduction in the scale of operations, moderation in profitability margins, deteriorated capital structure, weakness in debt servicing parameters, weak debt servicing track record, and other such reasons. The upgrades in the BFSI sector in the 9 months of the financial year 1920 were in the BFSI sector were majorly because of the improved profitability metrics in the BFSI sector, improvement in the asset quality, improved capitalization and leverage, strengthening of the asset profile, higher scale of operations or market position, enhanced liquidity position, better liability profile, and other such reasons. Reasons for upgrades in the 9 months of the financial year 1920 for the manufacturing and services sector were majorly higher scale of operations, improvement in liquidity position, better profit margins, improved capital structure, and improvement in the debt servicing parameters. We will now see the various sectors which have witnessed a moderation and the various sectors which have witnessed an improvement in the MCR. So the industries that saw a moderation in the MCR in the 9 months of the financial year 1920 were the NBFC sector, the construction sector, pharmaceuticals, real estate, iron and steel, telecom, chemicals and chemical products, information and communication, paper and paper products. The industries that saw an improvement in the MCR in the 9 months of the financial year 1920 were banks, hospitality, electricity, that is in transmission and distribution part, hospitals, sugar, beverages, information technology, and education. We will now see for some of these major industries the exact reasons and the trend in MCR in the 9 months of the financial year 2019-2020. The MCR for NBFCs, this is the rolling MCR that we've calculated for NBFCs. So the MCR for NBFCs has seen a moderation in the recent past. MCR for NBFCs was above 1 till Q1 FY20. However, there was a moderation from Q3 FY19 and the MCR fell to below unity from Q2 of the financial year 1920. The sector experienced a period of liquidity stress beginning in the third quarter of the last financial year as the risk perception of the sector changed and capital market funding dried up. The sector earlier faced ALM mismatches as NBFCs had increased the share of short-term borrowings to prop up profitability on rising costs and narrowing spreads, which exacerbated the liquidity and funding crisis faced by them. They also attempted monetizing their non-core assets, but the overall subdued market sentiment delayed these attempts, further worsening the liquidity stress faced by NBFCs. Despite the dip in confidence, NBFCs with strong parentage were able to manage their liquidity and market comfort on the class of assets sourced by them. The key reasons for the moderation were the ALM mismatches, moderation in asset quality, delay in monetization of the non-core assets, and the deleveraging efforts and resource raising plans did not materialize in a timely manner. MCR for the construction sector also witnessed a moderation in the recent past, the key reasons being the limited funding avenues, project delays, working capital being stretched, and liquidity mismatches. The sector was marred by varied challenges during the last few years on account of economic slowdown, regulatory changes, and policy paralysis, which had adversely impacted the financial and liquidity profile of players in the industry. Government of India has undertaken several steps for boosting the infrastructure development and revived the investment cycle. With this, the MCR for construction saw an upward trend till Q3 of the financial year 14-15, after which it started moderating, but was still above unity till the quarter 3 of the financial year 2018-19. It has, however, been below 1 from the quarter 4 of the financial year 18-19, mainly because of the general economic slowdown, resulting into drying up of funding avenues and consequent challenges like project delays, working capital gaps, and over-leveraging. The MCR for the pharmaceutical sector as well has seen a moderation in the recent past. It has earlier been well above unity since the quarter 3 of the financial year 13-14 to the quarter 2 of the financial year 18-19, after which it has seen a moderation and has gone below unity for the last 2 quarters, indicating higher downgrades than upgrades. This may be attributed to more stringent US FDA norms and increased competition in the US markets. The key reasons for this moderation have been high leverage, reduced liquidity, and decline in the scale of operations and profitability of the entities in the pharmaceutical sector. Entities in the real estate sector have also seen a moderation in the MCR in the recent past. The real estate sector, especially the residential segment, faced a slowdown amidst demonetization, rollout of GST, and introduction of RERA in May 2017. Demonetization led to a sharp slump in transactions in the informal property market. It not only affected the secondary market transactions, but also led to a sudden fall in premium payable for the new and old properties. The slump in the sector is evident in the MCR moving to below unity territory from the quarter 4 of the financial year 15-16 onwards. The key reasons for the MCR moderation in the real estate sector have been macroeconomic slowdown and consequent slow momentum in the bookings and collections, elongated project completion, deterioration in leverage, and the refinancing risk faced by the sector. We now move on to the industries which saw an improvement in the MCR in the recent past. So, the MCR for banks have seen an improvement in the recent past. The MCR for banks has been below unity since 2013, financial year 2013. However, it improved in the financial year 2019-20 due to stabilization in NPA levels and recapitalization by the government. The banking sector has been under asset quality pressure over the last few years, which has been impacting profitability. The asset quality continued to be under stress during the financial year 17-18. However, the pace of incremental slippages was lower and MCR started improving and moving up from the last quarter of the financial year 17-18. The regulatory landscape in India saw a structural change with the enactment of the IBC, that is the Insolvency and Bankruptcy Code, with cases being referred to the NCLT, that is the National Company Law Tribunal, under IBC, and time-bound resolution of long-standing non-performing assets has become possible. The key reasons for the improvement in MCR have majorly been the infusion of equity. MCR for the hospitality sector has also seen an improvement in the recent past. The foreign and domestic tourist arrivals, that is FTAs, increased by over 13.5% year-on-year to 10.4 million in the financial year 17-18, after registering a growth of about 11% year-on-year in the financial year 16-17. This growth was backed by various Government of India initiatives such as introduction of e-visa in November 2014, development of the rail and road infrastructure, along with promotion of medical and cruise tourism. In June 2016, the Indian government approved 150 countries under the Visa on Arrival scheme to attract additional foreign tourists. This push to the sector is reflected in the movement in MCR from below unity to above 1 in the quarter 2 of the financial year 16-17. The MCR, which was initially below unity, consistently moved to above 1 and has since then remained above 1. The key reasons for improvement in the MCR of this sector have been increased scale of operations and profitability, improved capital structure, and comfortable liquidity. The MCR for the transmission and distribution sector has also seen an improvement in the recent past. Over the years, all the grids were interconnected, with the country achieving the status of One Nation, One Grid, One Frequency in December 2013. Power Grid Corporation of India, that is PGCIL, which is the central transmission utility of the country, wields more than 45% of the total power generated across India. Apart from this, the Government of India is also promoting the private sector participation in power transmission space with a view to rapidly enhance the power transmission capacity. All future projects are awarded through tariff-based competitive bidding route, with exception only made in case of implementation of certain strategic and high technology projects, which are awarded to PGCIL on nomination basis. The total inter-regional transfer capacity of the country stood at 99 gigawatts as on March 31, 2019. The government has launched various projects to strengthen the existing transmission network and increase inter-regional transfer capacity. With this, the MCR for this industry has been above 1 since the quarter 4 of the financial year 13-14 up to the quarter 1 of the financial year 18-19 due to upgrades in the transmission sector, with a boost to the sector by the government. However, in the quarter 2 of the financial year 18-19, the MCR slipped below 1, with downgrades in the distribution sector due to absence of cost reflective tariff, high AT&C losses, and delay in subsidy receipt from respective state governments. The uptrend from the quarter 2 of the financial year 19-20 onwards is again because of the upgrades in the transmission sector. The key reasons for improvement in the MCR in the transmission and distribution sector have been the assured revenue in the form of fixed monthly unitary charges, improved liquidity with reasonable track record of receipt of dues from PGCIL or other applicable discoms, and improvement in the credit profile of the counterparty. We now move on to the trend in the CDQI, that is the CARES Debt Quality Index, which was earlier explained by Kavita. The CDQI had improved about 0.4 points during the year April 18 to March 2019. After improving slightly in April 19, the index has been declining for the previous 8 consecutive months, indicating a moderation in the credit quality of rated entities. The index fell sharply in June 2019, mainly due to moderation in the liquidity scenario for NBFCs and HFCs, resulting in sharp rating migrations. Thereafter, it declined by 0.54 points in the month of September 19, triggered by further downgrades in NBFC and HFC segment due to the continuing liquidity stress in the segments, making it difficult for entities to raise finance in a timely manner, as also delaying monetization plans. CDQI declined by 0.36 points to 87.98 in the month of December 2019. With this, we conclude our presentation, and we may go on to say that in the backdrop of the ongoing economic slowdown, with GDP growth expected to be at an 11-year low of 5% in the financial year 20, the overall consumption and investment sentiment is expected to be subdued. These conditions are unlikely to see a significant and immediate reversal, and the improvements would be gradual. This in turn could have an impact on the credit quality of the rated entities, and we do not see any notable revival in the same in the coming few quarters. Thank you. I now give it to Mridul.
Thanks, Smita. Kavita. Dear participant, will be having a break of 2 minutes before we begin our Q&A session. In case of queries, you are please requested to key in the questions. I repeat, we'll be having a break of 2 minutes before we begin our Q&A session. In case of queries, you are please requested to key in the questions. Thank you.
Hello everyone, welcome back. We've received a few questions. Thanks for the questions. I'll go through the questions one by one and respond to them. The first question is MCR interpretation could not be understood clearly as to how this impacts the credit profile of the companies and the economy. So MCR does not really impact the credit profile of the companies. MCR is a study of the credit profile of the entities and the downgrades and upgrades that have been undertaken in the past. So it does not impact for the future, but it gives you an understanding of how the credit profile of the entities have moved in the past over a period of time, and the trend helps us to understand on maybe some futuristic assumptions can be made based on the trend, but these only would be assumptions at the end of the day. So it basically it does not impact the credit profile of the companies. The next question asks about the MCR for auto and renewable sector. So the MCR for auto has been one in the 1.12 in the 9 months of 17 and 18, which has moderated to 1.08 in the 9 months of 18-19, and which has further moderated to 1 in the 9 months in the current 9 months. We move on to the next question. The reasons for downgrades of the credit quality in banks. So we've actually covered this in our presentation. There is also another question on banks which says that though the banks have seen forced mergers and the overall banking sector has been gloomy, so how has it been that the MCR of banks has improved? So as covered in the presentation itself, the MCR for banks has in fact been below unity for the period from the quarter 2 of the financial year 13 up to the quarter 1 of the financial year 1920. It is only now in the last 2 quarters that the MCR for banks have seen an improvement, and the reasons for these improvements have been that there has been equity infusion in these banks that have seen an upgrade. Also, I would like to highlight that the MCR that we are calculating is a rolling MCR, so it is rolling for the last 4 quarters. So this improvement that has been seen is mainly because of the infusion of equity in the banks in the quarter 4 of the financial year 18-19, which is getting reflected in this improvement in the MCR in the banks. However, the MCR for the banks have historically from FY13 has been below unity itself because of the reasons well specified in the question itself. Then the next question is what are the views on the performance of the NBFC sector? So, what we feel is that the growth in the NBFC loan book is expected to remain subdued due to the funding challenges and the lower consumption due to slowing GDP growth. NBFCs are currently conserving capital and correcting ALMs through portfolio sales, slowing down disbursements, and dipping into existing liquidity. However, overall, the sector is expected to remain well capitalized. The next question is, could you once again talk about MCR for NBFC sector and reasons for downgrades? Okay, so again, this was covered in our presentation itself. So the reasons for downgrades in the MCR for the NBFC sector have majorly been ALM mismatches, moderation in asset quality, delay in monetization of their non-core assets, and deleveraging efforts and resource raising plans which have not materialized timely. The next question is, can it be said that if MCR increases, the entities get upgraded and then NPAs will reduce in NBFCs. So an MCR actually talks about the past upgrades and downgrades. So as the ratio goes, the ratios is how we calculate it is upgrades plus reaffirmations upon downgrade plus reaffirmations. So if the number of upgrades have been higher in any of the rolling quarter, then the number of downgrades in that particular rolling period, then the MCR for that period would be above unity. That's how it can be deciphered. What is the outlook for the real estate sector? So even this we have somewhat covered. The real estate sector has seen some moderation, majorly because of the demonetization and RERA and all those things. And we have also seen that in the real estate sector there have been slow sales going forward. So we expect this again to continue for some time now, as we said earlier.
Yeah, I think that was the last question taken up for the day. There are other queries also which has not been answered, which we'll try to reply by email. Thank you again for being a part of this Care Ratings webinar, and we hope it was insightful and look forward to your participation in future also. In case of any queries, suggestions, and feedbacks, you are most welcome to write to us in the comment box, which will be coming no sooner the webinar ends. Thank you and goodbye for now.